Any of us can come up with a wonderful excuse not to take action if we do something and we give ourselves too urgent of a deadline. This is a big picture thing, so give yourself some time.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. Our next guest is Spencer Hilligoss. And today we discuss Spencer's journey from corporate America to passive investor, due diligence and vetting criteria for passive investments, and also we cover investor mindset. Spencer's the CEO and founder of Madison Investing, and his mission is to help busy, successful professionals invest passively and secure their most valuable asset of all, time. Before starting Madison Investing, Spencer was what some consider a corporate junkie by growing operations and sales teams in high-growth Fintech companies for over 13 years. And now, as a full-time investor and entrepreneur, he can spend more time with his family and honing his skills on the electric guitar. And without further ado, Spencer, welcome to the show.
Dave, great to see you. Really honored to be here. Thanks for having me on.
Yeah, always great to connect, Spencer. And I know people are going to enjoy your journey, right? I find that a lot of it we took in common, right? Coming from the tech sector and being in technology, kind of working that grind in that industry for quite a while. And I know we have much of our audience is actually in that sector as well. So why don't we begin there and, talk about your journey and, how it kind of started for you, how you got led down the path of, heading towards financial freedom.
Yeah, and I probably will start right out the gates with sharing a quick story, Dave, because we haven't caught up in a while. We just got back, meaning my family, my wife, Jennifer, our two young boys. We came back from a 5-week trip living abroad in the Balkans this summer. And I bring that up just right out the gates because that is something that would have blown my mind as a person grinding away like you and I both did in tech companies, right? I mean, I was in tech companies for 13 years in Silicon Valley, 80 hours a week in office for some of these early stage tech companies trying to quote unquote, build the rocket ship, try to get that big Meta Google IPO style exit that everyone dreams about. Never would I have believed that I'm able to go out and have this kind of autonomy that both investing and entrepreneurship can provide, and it's hard fought. It's the second summer in a row we've done something like this. Last year was Portugal. This year was Montenegro and Croatia. And traveling with young kids is hard. I'm not going to act like it's a cakewalk. But when you're living and running a business and reviewing investments on the other side of the planet, it reminds me why we do what we do. And I just wanted to share that because where the journey started versus where we are now is very different. So I was in 5 tech companies. I left to go full-time managing our investing club at Madison Investing in 2019. That was 5 months before COVID, and that was not part of the plan. I know you and I have talked about this a bit before, Dave, that, there's many chapters to the entrepreneurship journey, but certainly did not expect to pull the ripcord on leaving a 13-year leadership career in tech companies 5 months before a global pandemic, first of our lifetime. Even further back, though, my dad was a real estate broker. I grew up in a real estate household. That's what scared me into tech. I used to be a kid that played in punk rock and metal bands growing up, and I was not business oriented whatsoever. So, started out cleaning out fridges at properties for my dad. He was making me do open houses as a young teenager, and that was not cool to tell my friends growing up. So I thought, well, let's go join these tech companies. Fell in love with leadership, management, and, ended up running a team of over 200 people by the time I was 26. And that was, of course, like way in over my skis. That was how you learn painfully at times, but you also learn the merits of the hard work and the pain along the way that teaches you. So long story short, flash forward 13 years into that career, we had started investing ourselves, bought some rentals local, bought some rentals long distance, built up a portfolio. And then, it became quite a bit less passive than we wanted, dumping our former 401k money into stuff. So we started investing as LPs, and that's really what gave us the bug to start doing what we do now, which is investing in bigger deals, bigger properties, stuff that you and I know both you and I appreciate, Dave. But that's kind of the whirlwind overview of, the beginning and the end and everywhere in between.
Yeah, no, I love that. And the fact that you really had that spark, Spencer, and, that deep down really passion. I know you're such a great family guy, and how much you've really dedicated to that, and then creating your own life, right? To be able to support that, right? Because we talk about financial freedom, but it's also this other expansive freedoms, freedom of time, right? Freedom of location, right? Freedom of purpose. To be waking up every day excited about the work you're doing, right?
Yes.
And, that is the opportunity that we have in these times. But you had the courage to actually step away from what you were doing, to really, accelerate your purpose, accelerate those freedoms. So, kudos to you, because it does take a lot of courage. And I know a lot of folks listening, are always kind of thinking about that. And that's really one of our goals here, right? Is to share some of these success stories, just like you've had, Spencer, so people can, they can feel like there's other like-minded people out there. I'm having these same feelings. I want to have the same outcome. And you can do it, right? We're here to kind of encourage and show examples and things like that. So as part of that, did you have really an investment thesis, right? As you moved, from, full-time, getting a paycheck as a W-2 earner into kind of building up your passive income. I know you like to talk about it as cash flow laddering, and things like that. So talk to us a little bit about that wealth strategy.
Yeah. In hindsight, like everything else in life, Dave, whether it's business, relationships, kids, parenting, whatever, stuff always seems much clearer, right? It's like hindsight is 20/20, as the platitude goes. In reality, getting started in anything is clear as mud. And when I was working full time in the fifth tech company, this is where it all started for me. It happened to be a real estate lender. It was the biggest fix and flip lender in the country. Actually, they still are now. Used to be called Lending Home. Now they're called Kiavi. I was brought into that company to turn around and scale their loan origination team. As a guy who truly at that stage didn't really know what that meant, I had turned around teams. I'd scaled big company organizations and customer experience teams, but I hadn't done that. So I go in there. Over the course of a couple of years, I learned the ins and outs of everything related to that type of underwriting for that type of deal. The way that origination is managed, the way that you go out and evaluate a scope of work, on all these types of smaller projects that were sometimes run by big companies, sometimes run by first-time HGTV watching flippers who just said, hey, I got the bug and I want to do this to my home. And you're like, well, I wish you the best of luck. So I can't swing a hammer. Like I need YouTube to fix basic stuff. Like I'm an operations guy. I know how to do business partnerships. And I say all that because I saw the dollar amounts, like the number of zeros behind some of these transactions, right? Some of these flips that people were doing in the real world. And they didn't always have deep experience on some of these things. And I'm like, well, there's clearly something there. I was making, and my wife, Jennifer, were making great W-2 income, maxing out 401ks, been doing that for years, but we still felt like we were just barely paycheck, despite owning a home in the Bay Area, California. I live in Alameda, California now. Something had to give. And, I hadn't seen one of my sons in over 2 weeks because I was going in so early and coming home so late. So all of that stuff culminated for me right at that moment, which led to read 24 books in an 18-month period, devouring stuff on finance, devouring stuff on investing, and listening to podcasts that are quality education, just like yours, and that just kind of gets you started. And ultimately, we went out and bought a duplex in the Bay Area. It was $430,000 and $100,000 down for $200 a month in cash flow. And that's not what you call a cash flow win. That's, in hindsight, we kind of call that phase one of three. Phase one, buy local. We took all summer to buy that damn thing. And we still have it now. Yes, it's appreciated a lot. It's also a learning thing. So that was our thesis. Phase one, buy local. We're too scared to buy sight unseen. Phase two, we're like, let's go buy something still small, we get up to a portfolio of 5 single family rentals in the Midwest, $60,000 average purchase price, just like mind-blowingly cheap, right? Compared to what we see in the coastal markets. $250 on average cash flow across that modest little portfolio of doors. And we're like, wow, like that's much more profitable. But then we learn rentals are semi-passive at best. And there's still a place for them in a portfolio. Absolutely. Right. Like any other type of investment, it's a tool, but, we're getting notices from the county. There's a couch on one of the porches. We're getting tenant turnover every year in most of those units, killing our cash flow ultimately. And these are C-class properties. And we learn the difference between why you still have to go out in person and vet these neighborhoods, despite all the due diligence, despite hiring someone online to go and take a look at videos and video of the block, right? Like really, really analyze the heck out of all the financials involved. And that was the evolution of this thesis for me, is those 2 phases. And then realizing something's got to give, because we are very busy parents, working parents still at this time. So phase 3 was like, oh, wait, what's this whole buying a piece of a bigger property structure? And, that led into syndications. And I went deep on that, read more, networked like crazy, went to meetups. And that led me to realize, oh, I can just go and put in, we think our first one was $25K in a multifamily deal out in Alabama. And it went very well. And it was fully passive once you do the due diligence on the legal docs up front, which you absolutely still consider work. But that led us to say, okay, not going to invest in our backyard. A mentor said to me, in terms of thesis creation, he was like, Spencer, what kind of state do you live in? Do you live in a money state or a deal state? And I was like, well, I very much appreciate that framing, because that is like, clear cut, simple, and brilliant. It still is to me now. And it breaks the heart of the local California real estate market, of course. That's not to be derogatory to the people that I live near and respect here in this industry. But for cash flow investing, I still see it that way, investing elsewhere. So that's why we were looking in the Sun Belt. We were looking out east, and we're looking in different places in the Midwest. And we're looking for something that's a hard asset, a real asset that's bigger, more predictable. And that led us to multifamily. That led us to self-storage. And those 2 asset classes have been the primary focus for us, the lion's share of the portfolio that we had invested in. And then eventually when we built our investing club around that, Madison Investing, where we put our own money in along with our investors, and so we branched out from there further, but that really has been the thesis and how it came to be until today.
Yeah. What do you think are some of the considerations that investors should be thinking about in this day and age, right? I mean, there's been so many things going on. We've got a huge controversial election coming up. We've had, unprecedented rise in interest rates on the real estate side. There's just so many different things going on in the economy right now. And, are there some learning lessons that you can share with investors about, whether it be due diligence, investment thesis, or things that they should really consider at this point in the cycle?
Gosh. How much time do we have? I know that you and I can go long-winded offline talking about the conversation like this, most likely. But for the sake of big picture, big key learnings, as an LP, like putting in my own LP hat for a moment as a passive investor, flashback to 2018, compare that to now. It's like, what has happened? And you and I were chatting a bit about this before. Well, let's see. We've had a first time ever global pandemic hit. We have had the lifestyle adjustments to that. There was a small recession that happened in 2020, technically, right? It was like a blip compared to what has happened historically, but that counts. So we had COVID. We also had historically massive interest rate hikes, and the interest rates hikes fastest and most aggressive since the 1980s, right? And those have profound implications on the market. And have to say as well, there's some, what feels like ever present geopolitical uncertainty, and that's probably for a second podcast. But I think right now, those 3 things, if I recount the last few years as a from to what has informed new insights of how we do due diligence. And what has been the same is we use a 5-part vetting framework whenever we look at a new sponsor, because at Madison Investing, like that's what we do, right? We look at great deals all week, every week, from great teams, try to figure out who they are they up for the task, and then find the great deals that they're working on. So we look at the team, we look at their approach, We look at their comms, like their communications. We look at we have to look at their values, and we look at the legal structures, right? And I think that all of those, there's a nerdy spreadsheet behind those, but that still remains the same. Those buckets have not changed, right? Like the highest level buckets don't need to change. What has changed though is the following. Like probably the most profound examples of what has changed for me on due diligence. If I'm looking at talking to a prospective operator, we want to invest with them, let's say. Number one, the track record, right? Like when you and I look at a track record, or an investor says, let's show me that beautiful PDF document, that like investment summary, and it says, we have these exits. Great. You can't stop there when it comes to track record. Approach is really where it's at. And what I think of when I think of approach is like, market timing of when exits happen matters greatly. People can catch an upswing, but really capable operators can define and put on paper and walk you through in exhaustive detail what is their approach to their business plan. Like anything else, I'm a big guitar nerd, so here's a comparison point. Like if I learn how to play a really hard guitar song or solo, I can walk you through the exact steps that I took to be able to perform that thing, and it did not happen quickly. I'm not a savant. I have to learn the old school hard way. I have to practice a lot. Same thing applies back on the business plan front. If a sponsor or a team knows how to do something well, and I want to de-risk this approach as much as possible to de-risk execution risk, which is the biggest risk on a passive investment, I have to make sure as best I can that they can do that again. And that their big exits with their sexy looking IRRs were not just a flash in the pan because they caught the right moment, they bought the right asset, and they happened to peak the market right at the point where they could exit that thing. So that would be number one. I think number two would be, said simply, extraordinarily transparent and ideally third-party audited financials. that would be the gold standard. And I'm only chuckling because it sounds really simple. In the private market, as you know, Dave, like so much is bespoke, so much is understandably opaque, right? If a sponsor's competing for a great deal, they can't go out and scream to the high heavens, hey, I found this great property. We're going to buy it at a discount and it's under contract. So let's go tell everyone about it. That type of private market dynamic cannot apply when it comes to vetting a team. And if they have a great deal, the ability to see, are they in a position at the company level, the company itself, like do they have sound financial footing on their balance sheet to persist through whatever may come? And number two is that deal's financials truly transparent? Like are we able to see, all this stuff, the T12, the historical, the rent roll, all that good stuff. So thanks for indulging the diatribe. But I think that those two big buckets, of approach plus like an exhaustive level of due diligence on financial transparency are things that have been deepened in the way that we look at stuff now.
Yeah, good insights there. I would definitely concur with that. And, just to add, I think to the audience, we're always learning. And there's been some hard lessons, but when you make those hard lessons, you have those challenging times, that is truly the raw material for your success and for your growth, right? And one thing, I think is fascinating that we spend a lot of time really studying the ultra high net worth, how our family offices, some of the wealthiest in the world, actually allocating capital. How are they thinking about the geopolitical events and things like that? And they're really looking to, invest on a 25-year basis. Right? They're going to go through multiple election swings, right? Where it's going to go back and forth, against different parties. Operators, do they actually have a continuity and plan, business continuity plan? Do they have a legacy, a succession plan, right? Things like that. So they're really in it for the long term. And then so when you break down some of those fundamentals, where can you constantly de-risk, right? And hedge. And also, I think one thing that's really important for people to keep in the back of their mind is that there is risk everywhere. Okay. So I go back to this story that, my wife was gifted a sizable amount of equities from her dad generously into some blue chip stocks, one of them being Kodak. And, she sat on it because it was very sentimental. And, one day Kodak's bankrupt No recourse, no nothing. And it was touted by all financial advisors, Wall Street, you name it, as one of the safest, most blue chip stocks. And there was no recourse, no nothing, and it went to zero, right? I can also think of in the past 12 months, we had a numerous amount of banks completely go under, and a bank is supposed to be the safest place that you can actually keep your money. So the lesson here for the investors, I think, is just that there is always risk, right, with your capital.
Yes.
So, never keeping all of your eggs in one basket, right? Having focus, I think, in core sectors, like you have some great focus there, versus kind of that stock market diversification, which is really diversification, because you're spread across so many things. So when the market popped, it was down 3+% the other Monday, it doesn't matter what you own, you're down. Yeah. Right. So I think having, focus, not putting all of your eggs in one basket, and really thinking about those fundamentals for the long term are really some, key considerations people should be thinking about.
Well, thank you for sharing this story and just the learnings. I think the Kodak story is potent, right? I think prevailing opinions from pundits in the world's most brilliant minds, far and more intelligent than me on the IQ scale, that's for sure. They analyze everything out there when it comes to take a snapshot, right, back at 2021. Virtually every forecast out there said, well, clearly, 0% interest rates. Let's talk about the rates. 0% interest rates cannot persist. What goes down must come up. What goes up must come down. And that sounds so basic to wrap my head around, right? I did not see a single forecast, and I'm still waiting for someone to send me one, that just showed the severity and the intensity and speed of the rate hikes that we just experienced. Yeah. And so it gives me pause. I mean, there's a learning there, clearly. But I think it also gives me pause when I hear people speak in absolutes about, man, everyone, I should have known better on this one deal, because I've invested in some incredible deals that have gone full cycle, and we're still in some excellent deals right now. There's fewer deals available right now because the rates are a little bit punitive on freeing up the market to go have more transactions. However, I just wanted to call that out. Is like, it's anytime you're de-risking an investment, anytime you're de-risking a decision to the best of our ability, it's a snapshot. And it's a snapshot in time. Still waiting for my crystal ball to arrive in the mail. It's like, I still don't own one, right? Yeah. None of us do.
Yeah.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah, it's true, right? I mean, you can go, you pick your channel, whatever you want to watch, and there'll be a pundit talking about, one technical analysis of whatever it is, a sector, a stock, interest rates, whatever. And then you can find someone who's equally as, qualified, just talking about the complete opposite thing, right?
Yes.
And that's where it becomes, I think, very difficult. But when you look at family offices and some of how a lot of these people invested, it's really for like fundamentals, right? And to your point of like the team, who are you investing in? Because if you're investing in the team, they actually have resilience, right, as entrepreneurs to be able to shift. So, okay, things are happening during a pandemic, which never happened before. Now we need to repurpose the business. We need to, pivot or do something differently, or lower our costs, or find new, ways to generate revenue, right? And yes, that's really the opportunity, right, within private investing. And, to your point, if you're investing in the right team, right, they have the ability to execute well.
Gosh, there's a real nugget there. That's a brilliant comment. And I give you two examples from recent times that it hits home for me, Dave. De-risking the who, truly vetting a team. Like when we say vetting a team, there's been deals that I personally invested in where you've got a robust team, maybe 2, 3, maybe more general partners actively involved. Maybe they're specialized. One person is kind of the CEO hat. One person is more of a finance focus. One person knows their construction. If it's a heavy rehab focus, they buy apartment buildings to renovate. Maybe they do storage facilities. The point being, when I invest in those teams and I see them navigate COVID, I see them navigate high interest rate environments and oversupply markets right now, they have to change and adapt. Some of them will say, oh, we've been using third-party property management. We're going to go vertically integrate. I've seen some partners and some folks we've invested with, they go back because they realize vertical integration was a mistake for them. Those are very large changes for a team to navigate in the middle of an active investment during their hold period. And not even talking about the other disruption coming from inflation, coming from geopolitical challenges. And so just to validate your comment, I completely agree with that. I think that one of the things we didn't chat about earlier, but it's implied, but I want to make it really clear for folks, because this has been helpful for me. Like this is, it's like you're saying, there's humbling moments out there along with the wins, right? And in those humbling moments, here's a key learning on the team is really drilling down to, are you looking at a scenario where one operator, one person, one human has absolute control, regardless of the structure, no matter what you see in the docs, no matter what you see in the PDF? That is to be avoided. And it sounds simple. It's actually quite a bit harder to spot than people realize. And so I think that, we can do a criminal background check, civil background check. We can go down the professional background check, which we do. We do all of these things. We do the due diligence, but you're also taking a snapshot of one human. You're taking a snapshot of a human being, and ideally on a team in a larger organization where we talk about big picture, long-term investing wisely with that profound insight you're saying about family offices looking at a 25-year time scale. It makes total sense why they look for strong teams, because the teams are resilient. They don't end up having a overly focused single source of power in a deal that can sway whichever way that happens to go. And maybe it's not favorable, So I just wanted to hit home on that because it's a great comment.
Yeah, for sure. So where do you think the opportunities lie, Spencer?
Right now we are fired up in two different areas. This is where we're focused. The first is in private credit. The banks have pulled back. Interest rates are high, but also banks are lending less, and particularly on the assets that I know you and I appreciate, Dave. So, large, commercial real estate, particularly within apartment buildings and also on self-storage, but other places as well. So there's a need. There's a need. So what fills that need is private credit, private debt, and the ability to go out and, invest alongside and become the bank as an investor is very interesting because we're able to go take a less risky position in the capital stack, right behind the senior lender or even, as the senior lender, depending on the structure. So those types of investments are very interesting to me. Also, just when, great deals exist, but it may not necessarily be participating as a common equity investor. It may be coming in as preferred equity, right? Or mezzanine. So that's the first one. The second one being there are deals, they're just harder to find and they're less common. So I'd say that certain deals truly bought at a discount right now. We're looking for longer hold periods, kind of akin to a similar ethos and investment thesis you're hitting on from the family office side, looking for deals that are purchased at a great upfront yield on cost, and I think that going in, accepting that it's got cash flow in place already, hard to find, but when you find them, we're going to pounce on them. So we're just kind of sifting through the market, looking through as many opportunities as we can, to find those diamonds in the rough.
Yeah. Well, with the latest guidance from the Fed at, potentially, lowering in next September's meeting, maybe again later this year, do you think that there's a tipping point, right, where there's going to be a point where we just, strike in the market, right? Because there's going to be some great multifamily assets on sale that we can get in for buyers who have capital?
I do believe that to be true. When is of course the thing I'm not going to, chisel here into a rock right here, but I'd say that the most recent forecast for the Fed interest rate says that it's going to be at least a 0.25 point reduction, likely in September. I've really given up on trying to make my own firm forecasts on what that means, but it's likely we will have at least the first one this year, right? Is that going to suddenly open up transaction volume and have a bunch of acquisitions, showing up on the market potentially? It's going to take a bit. I think it's going to take at least 6 months personally. So I think in the back half of 2025, we're going to see a material increase in the number of transactions. And of course, there's 1,000 different opinions people out there might have about that are far more read up on this than I am, and they're deep in the industry. But that's what I would expect. I think if we look further into more like 2026, then it's going to get really interesting. I think we're going to see a lot of movement, particularly also because the primary source of a great deal right now is because of floating rate debt on a property, right? That is, if a loan that has been on a 3-year term coming up for an interest rate cap renewal, or a property that simply can't service its mortgage payments anymore, its debt payments, then the clock is still ticking, and it's not ticking favorably for some of these assets that are out there. They've been able to extend, some of them been able to renew, to renew and buy new interest rate caps, but some cannot. And as a result of that, it's ramping up the number of properties that are going to be experiencing some form of challenge, and that might lead to a sale event, which leads to, on the buying side, a really great deal. And so I think we're keeping our eyes out for that as we go throughout the next 18 to 24 months.
Yeah. How about on the self-storage side?
Yeah, self-storage, man. I think it became, I would say, my favorite asset class over the last few years within commercial real estate, because it's just the best kind of boring. What I don't think any of us necessarily expected when the interest rate spike happened is that the relationship between storage occupancy, storage rent rates, and the values in relationship to single family home market movement. That's got to be one of the most fascinating dynamics that, in the short term is painful for self-storage, because the valuations were going so killer, like growing and growing and growing through 2021, akin to many other asset classes. But right now it's surprisingly resilient, despite the fact that people are not moving because people aren't buying homes and selling homes. Storage is used mostly with, all the 4Ds, right? That's like death, divorce, et cetera. Those big moments in life that drive people to store their stuff while they move or relocate, like to another state altogether. So I think that the institutional demand for storage is still robust, meaning bigger institutional investors want to buy portfolios of improved, efficient, strong NOI self-storage facilities, but they want to buy them not, self-storage facilities are relatively inexpensive compared to a $40 million apartment building. So you'll see them typically packaged up in this playbook used by so many great sponsors right now. They buy mom and pop, they improve the facility, they want to put them into one fund together. And if they do it correctly, they put together a really attractive looking portfolios for a potential institutional buyer. I think that playbook still holds water, but there needs to be a rebound in the market before it can really be capitalized, right? Like before it can materialize rather. So I think that's where it's at right now. I think storage, I'm still receiving distributions from multiple storage investments that I've made in multiple funds, pleased with those. I think that it has shown a bit more resilience than multifamily. And that's just the difference in the structure between the two. But it's a rosy forecast, in my opinion, for storage. And there's not that many, it's a consolidation moment still for a lot of the storage players in the top 25 list.
Yeah. One thing I love about the alt space, and it's always comical to me why it's even called alternative investments, because to me, these are tangible hard assets versus, public equities, right? They kind of move and go up and down based on the wind, it seems like. But, one thing that's really helpful, I think, for investors is when you're traveling this summer, right? I mean, get out and about and just get a feel for what's going on. I mean, I live in Florida now, and just seeing the amount of those new self-storage buildings going in, and also even as a resident, there's no basement. We moved down here, from Virginia. There's no basements here, and people come. They typically have bigger homes. You have all this stuff. There's nowhere to put it. So it really makes sense. And then you look at the population numbers and the demographics of people coming in. And so a lot of those, numbers really kind of add up, right? And you can see it right in front of your eyes, right? So I think it's really helpful for people also to do some of their own, as part of your due diligence, right? Just reach out and go to a specific market. If it's a multifamily property, drive around yourself and get a feel for, how busy is the area, right? Are the shopping malls, teeming with people going in and out, or is it kind of dead, right? All of those kind of things, which is what's so great, right, about investing in real assets.
Yeah, real assets and hard assets. That is one of the coolest parts to me. Like I think you nailed it. It changes the investors and my own perspective. Walking on the sidewalk, walking through the apartment community, looking at the units. I mean, talking to people that live there. Like that stuff makes it tangible in a way you just can't necessarily do when you're buying a share of Apple stock. And so, like, for what it's worth, I do think that is a spot on observation, particularly if you want to go do some more de-risking. See the neighborhood, right? I think that the market insight there for folks who are still kind of newer to this space that you're hitting on, Dave, is so profound, which is we all read the newspaper, and when we see it say real estate's up, real estate's down, the market is up, the market is down. I don't give much credence to that in real estate because it's hyper local. It's always been, and of course there's broad correlations, but yeah, you got to see the block.
Yeah, for sure. Spencer, if you could give just one piece of advice to listeners about how they could accelerate their own wealth journey, what would it be?
Oh man, set the goal based on income or net worth that you want to hit and within what time. To be specific, Jennifer and I sat down, this is back in around 2016. This is brief. We said, how much monthly passive income do we want to hit and by when? And it was a very challenging exercise, but that created a compass for us. And it's what eventually allowed me to move on from my full-time strong income W-2 and eventually Jennifer leave hers in 2021. Of course, we've adjusted that along the way as life evolves, but it starts there. It's as simple as it sounds. Pick a number, put it on a certain time-bound time scale, and then work toward that. But don't make it too soon. Like, that's the one caveat I would say, is that any of us can come up with a wonderful excuse not to take action if we do something and we give ourselves too urgent of a deadline. This is a big picture thing. So give yourself some time. We said 15 years in our first slice for the goal. And then we came back the next week and set it to 7. But we ended up hitting it in 5. So, it's the clarity of that goal is everything.
Yeah. No, I love it. I think, being crystal clear on your vision is so powerful, right? When you have that, and like you say, it's a compass. And you mentioned something earlier, I think that was just so spot on for people to tune into, right? Which was, the best investment was the most boring, right? When you talked about self-storage. And, it's really important to understand that this is really about a process, right? So once you have your goal in place, you work on your process and start to optimizing it, right? It's because you have to be making strides every day, every week, every month. But if you don't have that goal in place, you're not going to get there.
100%. I mean, learning to love the process is its own, challenge. And I'd say once you can get there, it becomes more, it blurs the line between work, passion, hobby, calling, as nerdy as that sounds. I really believe that has been an important part in my own investing journey, is realizing this can be fun. I know for a lot of people that are sitting there thinking, like I probably thought earlier in my career, finance and investing is boring as heck. You're talking to a guy who used to, literally say, I don't want to be in business ever, when I used to play in punk rock bands, right? And then coming full circle to say, it's fun to nerd out on this stuff, but it's also done in service of the most important thing in life, which is liberating oneself to focus on your family, your calling, your true calling, whatever that happens to be. Because that's why money is just a tool, man. I mean, the money is the tool. The money isn't the end all for us. For some people, it might be. No judgments if that's the case. But the clarity of the goal, loving the process, executing regularly, that moves you materially toward the place where you have the tools to go and focus on the things that matter the most. And that's why I brought up front, like, hey, living in another country for 5 weeks with your young kids, that would have been so unrealistic sounding to me earlier in my life. But the process over the course of now coming up on 8 years of this journey for me, it has yielded that opportunity.
Yeah, that's awesome, Spencer. I find it really fascinating, right? A great example of, building wealth is just a process. Is think about how many people that are, multimillionaires, centimillionaires, even billionaires that have actually lost everything. And guess what? They got right back to where they were or exceeded that, right? And how do you think they did it? They lost all of their capital. How do you think they did it? It's because they figured out the process in the game, right?
And they channeled those painful learnings forward, right? I think, gosh, that is a really good insight to bring up, Dave. I feel like that is why there's now, I think there's even a show or two, reality show or two, where they give like capable, wealthy people who have lost it all to get it all back. They give them like $50 or $100 and they have to go turn that into a much larger number quickly, for exactly the ways that you just described. They know the game, yeah. They know how to play it, and they also have an immense awareness of their own skill of resources and relationships too, and understanding the relationships available to them. All of those are in the toolkit for an investor to go and learn, because the books help as a starting point, but you also have to go out and start taking some action at some point too.
Yeah. Awesome. Spencer, always a pleasure to get together, and really appreciate your time and sharing your insights and strategies with the community here. If anyone would like to learn more about you, connect, or learn more about Madison, what is the best place for them to reach out?
Yeah, well, folks can find us at MadisonInvesting.com. They can request an invite to join our investing club. And, it's a no obligation thing to set up a call with me. Just like to nerd out on investing and try to be a resource for folks. This has been a blast, Dave. Thank you so much. And it's just really great to reconnect with you. It's been a long time.
Yeah. Appreciate that for sure, Spencer. And to the audience out there, we will see you next week. Thanks for listening. Make sure to subscribe so you make sure you don't lose any episodes like this one with Spencer.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.